The U.S. economy is changing rapidly. Interest rates are decreasing, real estate markets are responding, and trade wars are intensifying. With the stock market facing pressure, today we're exploring Kansas and Missouri's latest real estate trends, the Federal Reserve's upcoming decisions, the challenges facing the U.S. economy, and the risk of an escalating tariff conflict with Canada. It's been over 25 years since the dot-com bubble burst. Are we repeating history? This is your March 2025 Economic and Market Update. Welcome to all. It's Tyler from CB, powered by Movin' Lab. All right, let's begin. Let's talk real estate. The Kansas and Missouri markets are a tale of two sides. Tight inventory in some areas and buyer opportunities in others. Let's break it down fast. Johnson, Kansas, still hot. Prices are up 2.51%. Inventory down 10%. Buyers be quick. Jackson, Missouri, sales were down 8.6%, but prices jumped to 8.5%. Buyers are stretching budgets to compete. Wyandotte, Kansas, there's a big shift going on. Sales dropped nearly 19%, but inventory is climbing, making it a buyer's market again. And Leavenworth, Kansas, steady as she goes. Prices are up about 4%, but sales have slowed a bit. It's a balanced market. Platte, Missouri, huge 38.5 inventory surge, pushing prices down 4%. Buyers, this is your window of opportunity. Clay, Missouri, tightening up. Sales are up 2.5%. Inventory is shrinking, and prices are rising. Still a seller's game. The bottom line, if you're in Johnson or Clay, expect competition. If you're in Wyandotte or Platte, buyers have leverages. The game is changing. Move smart, move fast. Interest rates are the biggest factor shaping today's market. So what's happening? Let's go. The Federal Reserve is holding rates steady at 4.25 to 4.50%. No cuts yet, but they're watching inflation closely. Inflation's still at 2.5%, not crazy, but high enough to keep the Fed cautious. Typically, we're looking around 2%, but there's good news for buyers. 30-year mortgages just dipped to 6.7%, and slightly cheaper home loans could bring more buyers back into the market. The 10-year Treasury yield is falling. A sign-up market expects slower economic growth ahead. The bottom line, the Fed isn't cutting rates yet, but the pressure builds. If you're buying, this dip in rates is your window. If you're selling, know your market. Demands could shift fast. The market is a roller coaster right now, but here's one thing. I don't think we're on the doorsteps of a recession just yet. This looks more like a growth scare or a slowdown, not a full-blown crash. A physical asset can always decrease your risk. Let's talk about the tariff war and how it can impact real estate hard. Builders are getting squeezed. The U.S. just slapped a 25% tariff on Canadian goods, Canadian-related lumbers and material. Prices are set to skyrocket. Canada is a major supplier of softwood lumber, a critical material for home building. Building costs expect new home prices to rise because construction companies will pass higher costs on to the buyer. Supply chain delays. Tariffs mean slower imports, higher costs, and fewer new homes being built. Tightening supply. Buyers beware. If you're considering new construction, locking in now could save you thousands. Wait too long and you'll be paying inflation-driven prices. Bottom line, tariffs make building more expensive. Even in cooling markets, pushing home prices higher. The economy is shifting quickly, and three major factors: down, a weakening dollar, and the new administration influences what happens next in our real estate. The government shutdown. With 62,000 federal jobs lost, consumer confidence is declining, which may slow home buying demand. However, low inventory is keeping prices stable. A weaker U.S. dollar increases the cost of imported goods. including lumber, steel, and home appliance. Builders will transfer these costs to buyers, making new homes more expensive. Also, tech stocks are underperforming, similar to 2000s, but back then real estate was viewed as a safe haven asset. History might repeat itself, positioning the property as a substantial investment in an uncertain market. All right, let's wrap this up with the big takeaways. Interest rates are holding steady, but mortgage rates are dipping. Buyers, this is your home prices are still rising in key markets, but new construction will be more expensive as material costs increase. The stock market is shaky and real estate remains strong. Learn from the dot-com bust. Smart money moves into assets with lasting value. The government and trade wars are shifting the economy. If you wait too long, costs would while demand slows. The bottom line, if you're a buyer, get in before rates and prices climb. If you're a seller, position yourself now.